You won't believe what happened to this advisor, and I don't think you want to do this, so watch to the end. But in this video, we walk through the story of an advisor whom in the eyes of the court traded a little too much in his TFSA and is paying for it now. Let's dive in. My name is Joe Macek and I'm a portfolio manager and investment advisor for IA Private Wealth. Welcome back to my channel, Investing Made Simple, where you can find the most trusted information on building your wealth. If you're new here, thanks for checking me out. Feel free to subscribe and hit that notification bell so you can be notified when we upload new content. Today's story is super interesting as it has a lot to do with what I'm sure a lot of you might be wondering. At what point does the CRA think you are trading too much in your TFSA? Introduced in 2009 by the Canadian federal government, the tax-free savings account program was designed to provide Canadian families and individuals with a responsible avenue for planning their retirement or making significant life purchases. Unlike other registered savings plans like the RSP, contributors to a TFSA cannot deduct their contributions from their income in the same year. Instead, according to Canada's TFSA regulations, any income generated within a TFSA remains tax-free, and withdrawals made by the account holder are also tax-free. Consequently, TFSA holders are exempt from paying taxes on interest, dividends, and capital gains, or any other income that accumulates within the TFSA. Or are they? Now, we are actually going to take a very close look at a court case, but before we dive fully into the video, if you have any questions about how this content relates to your own personal investments, it's best to reach out to me one-on-one. You can find my contact details in the description below. With over 24 years of experience, I offer fully licensed, trusted investment guidance and planning for your retirement, estate planning, investing, and other financial needs. There's no obligation when you reach out, so feel free to contact me at any time. Okay, now back to our video. A tax-free savings account is commonly set up as a trust with a registered issuer like a bank or credit union and has extra rules about how it's managed, the contributions allowed, and when the income it earns might be taxed. Specifically, according to subsection 146.26 of the Canadian Income Tax Act, income earned within a TFSA trust could become taxable if the trust engages in business activities, including trading. The CRA deems certain activities such as foreign currency trading, option writing, and excessive stock trading as constituting business activities, making income derived from these sources subject to taxation within the TFSA. The recent case of Amed versus the King 2023 serves as a cautionary tale, revealing the potential hazards associated with excessive trading within a tax-free savings account that could lead to the loss of valuable tax benefits for Canadian taxpayers. Notably, the Amed ruling holds significance as it marks the very first instance where the Tax Court of Canada was tasked with defining the precise circumstances under which a TFSA would be considered to carry on a business within the context of Canadian law. The case, resolved in February, featured a Vancouver investment advisor who established his TFSA in January of 2009. His self-directed TFSA exclusively dealt with securities that were considered qualified investments according to the Income Tax Act. Most of Ahmed's TFSA investments were non-dividend paying and speculative in nature, with the majority being penny stocks in the junior mining sector listed on the TSX Venture Exchange. His TFSA owned most of the positions for brief periods. Amed made the maximum permissible contributions of $5,000 to his TFSA in early January for the years 2009, 2010, and 2011. By December 31st, 2011, the TFSA had increased in value to a staggering $617,371. Whoa, good job, Amed. In January of 2013, he sold the securities in the TFSA, transferring almost $547,800 to himself without incurring any taxes. Wow. But not so fast. The CRA reviewed the taxpayer's TFSA for the taxation years 2009, 2010, 2011, and 2012, and the CRA claimed that the TFSA was involved in the business of trading qualified investments, making its income taxable for each of those years. The assessed taxes were calculated based on taxable income amounts of $44,270 in 2009, $180,190 in 2010, $330,994 $1,000 in 2011 and $14,027 in 2012. This reassessment, of course, spawned a lawsuit, and in this legal battle, Ahmed's very experienced Canadian tax litigation lawyer presented some pretty inventive and unconventional arguments, delving into the legislative framework governing TFSAs and the underlying policy objectives supporting tax exemptions for TFSA trusts. Despite the lawyer's creative efforts, the Tax Court of Canada remained absolutely unmoved, showing little sympathy towards the taxpayer's position. You see, in assessing whether a taxpayer's profits come from securities amount to conducting a business, the CRA takes several factors into account. These factors include the frequency of transactions, how long the securities are held, the intent to acquire securities for resale at a profit, the nature and quantity of the securities, and the time dedicated to the activity. The judge in this case emphasized that given the taxpayer's active trading within his TFSA, there was absolutely no question that the taxpayer was engaged in the business of active trading within his TFSA. Ultimately, the court concluded that the taxpayer had in fact engaged in business activities through the TFSA based on conventional criteria, resulting in the taxation of the income. The court emphasized that even when generously interpreting the law and its historical context, the taxpayer's argument was deemed unsuccessful. The Amed case serves as a stark reminder of the potential pitfalls of TFSA holders engaged in trading activities, highlighting the importance of adhering to established legal boundaries. So why don't we have a closer look at the arguments for and against so we can get a deeper understanding of exactly what the CRA looks at. When governments make laws, they can't cover every possible situation. So when words in the law are unclear for someone's situation, the court system steps in to figure out what the law really means. In Canada, there are established principles for interpreting laws. The courts look at the exact words used in the law and try to understand what the government meant when they made the law in question. They don't try to put their own ideas or preferences into the law. This is especially important in tax law, where the courts emphasize closely examining the specific words to make sure that people can understand and follow them. The goal is to give the words in the law their full meaning, so taxpayers can be sure about how to handle their taxes in a complicated system. In short, when governments create laws, they try to cover a lot of situations, but it's tough to think of everything. That's where the courts step in to help out. Laws are like instructions, and sometimes those instructions are a bit unclear, especially when it comes to someone's unique situation. They want to make sure that the rules are fair for everyone, no matter what kind of tricky situations people find themselves in. Ahmed's lawyer tried to argue four main points in their position, and you can read the full dissertation from Tax Law Canada, but I put it here as best as I could, not being a lawyer and in plain English. Remember, these are the points that they argued from their interpretation of the law. Now, Ahmed's lawyer said that a tax-free savings account operates as a registered savings plan similar to an RSP under the Canadian Income Tax Act. According to paragraph 146(4)(b) of the Act, income generated by an RSP through engaging in the business of trading qualified investments is exempt from taxation. The rules in the Canadian Income Tax Act that stop tax-free accounts from being misused were designed to make sure everyone plays fair. They want to prevent tax-free accounts like those for charities and nonprofits from competing unfairly with regular taxable businesses. Since the outcome after taxes are the same for putting money into a tax-free savings account or a registered retirement savings plan, it wouldn't make sense for the law to stop a TFSA from doing a trading business while allowing an RSP to do the same thing. The usual way of deciding if someone is doing a business of trading stocks was not designed for accounts that don't pay taxes, like a tax-free savings account. Firstly, the regular test doesn't consider the special advantages that entice TFSA holders to want to invest in certain stocks. For example, TFSA holders are encouraged to take more risks and invest in riskier things, knowing that the rewards would be tax-free than if they weren't. Secondly, the way TFSA investing works means that some of the regular things looked at in the test, like using borrowed money or advertising, doesn't really apply. In the end, the regular test puts too much focus on how much the TFSA holder knows, making it harder for professional investors to benefit when they invest through a TFSA. In the case of Prochak versus the Queen 2014, the Tax Court of Canada determined that engaging in trading activities within a registered retirement savings plan does not qualify as conducting a business of trading. That's right, apparently you can blow your brains out trading in an RSP, and according to this case and their interpretation, it isn't considered the business of trading. Ahmed's lawyer also argued that the court court's comments, even though they specifically related to RSPs, should be extended to TFSAs, as there was no logical reason to withhold the extension of these conclusions from the RSP context to the TFSA context. Now, this is what the CRA lawyer argued, hopefully in plain English. Now, it's not surprising that the lawyer on the other side representing the CRA obviously had a different opinion. The CRA's lawyer argued that when you look at the whole context of subsection 146.26, it has a clear and straightforward meaning. According to them, opposing counsel's interpretation of the provision was seen as an attempt to essentially rewrite the law through judicial interpretation. Now, here was the CRA lawyer's interpretations. In Canada, there's a basic legal principle that assumes Parliament understands the existing laws, including common law. And in 2008, when they added Section 146.2 to the Income Tax Act, it was already known that a person could have a business by trading securities, and figuring this out was always based on the specific situation. The idea from Ahmed's lawyer would mean adding a special rule to protect a tax-free savings account doing business by trading certain investments. This would create a hidden exception in the law, going beyond what's clearly stated and interfering with Parliament's job of making rules. Parliament had the option to treat the tax-free savings account the same way it treats RSPs, but it chose not to give TFSAs the same benefits that RRSPs get for business activities with certain investments. This decision makes sense because, unlike TFSAs where withdrawn money is permanently tax-free, with RSPs, the funds taken out are taxed as regular income. If Parliament wanted to make the TFSA trusts exempt from taxes on trades involving certain investments, they would have written the law that way. Since they didn't, Ahmed's lawyer's argument doesn't hold up. And by the way, the things that the court said in the Prochuk case don't really support what the taxpayer is arguing here. In Prochuk, the court said that the trades in an RSP are not relevant in deciding whether an individual is in the business of trading. It's about the person, not the RSP itself. The Tax Court of Canada didn't take paragraph 146(4)(b) of the Canadian Income Tax Act into account when it made its decision. This part of the law clearly talks about an RSP trust doing business trading in certain investments. So since the Tax Court of Canada didn't consider this part, the things that they casually said in Prochuk don't have to be strictly followed in this case. The judge concluded that the person who's an experienced investor frequently trading speculative stocks in their tax-free savings account was essentially running a trading business within the TFSA. Due to this business activity, the income earned in the TFSA was considered taxable. Considering the taxpayer's frequent trading patterns, track record of dealing in speculative securities, and their level of knowledge and experience, it was undeniable that the TFSA trust was actively engaged in the business of trading qualified investments. So based on that case, how do you make sure as a TFSA investor you minimize the chance of a CRA audit? Well, the CRA looks for certain factors like the ones we're going to go through, and these factors may lead the CRA to believe that your tax-free savings account is in the business of trading. And here they are. You frequently trade securities within your TFSA. You quickly sell the securities in your TFSA. You have knowledge or experience in the securities markets. Securities trading is part of your regular business or job. You dedicate significant time to studying securities markets. You use borrowed money to buy securities for your TFSA, though this might also disqualify the TFSA from tax-exempt status as per paragraph 146.22F of the Canadian Income Tax Act, which restricts TFSA trusts from borrowing money for TFSA purposes. You publicly express your interest in buying securities. The securities in your TFSA are speculative or don't pay dividends. Now, the experience of the TFSA holder, Amed, in the Amed case, being an investment advisor sure didn't work in his favor when the court made their decision. However, it's important to note that even an amateur investor might face unexpected tax liability considering the circumstances. After the Amed ruling, it's critical to consult with a knowledgeable Canadian tax lawyer before engaging in any frequent trading activities in your TFSA to avoid potential issues in a CRA tax audit. Did you know that there are many studies suggesting that clients with an investment advisor or portfolio manager tend to be less anxious, happier, and more confident, often resulting in a net worth up to 3 times higher than those who manage their investments alone? Do you want to know how to choose a good financial advisor? Well, click here to learn the amazing differences between advisors. We'll see you soon.